All right, I think we'll get started. Nice to be back in person at TCF. The last couple of years I spoke via Zoom, so it's nice to see actual faces. All right. How do you advance to the next slide?
If you click there, it should work. Yeah, just click there once. Your slides. You have to
Okay.
click on the left screen. Yeah.
Oh. I'm sorry.
I got it.
You'll have to show me.
Click your slide right over here.
Okay. Here.
Yep, and then you should be able to.
Oh,
yeah, you gotta actually start your slideshow real quick. Actually didn't start for some reason. Click right out here on side of it. And then start
again.
Yep. Yeah, that's interesting. It's not actually starting his presentation.
Seems every year that I talk, there's always something going on. It's this slide would apply to virtually any talk I've given in the past 20 years, but there's a lot going on now. This is a view of myself in the center there, and the fellow just to the right of me is Don Liebes in the back, one of my oldest friends. And this is a TCF, the year I graduated from high school. Oh my. Usually financial talks have some sort of indecipherable disclaimer attached to them. Don't bother reading it. This is a much better one. A lot of what people say in financial seminars, I mean, I remember back to when you would read a print ad, send someone a few bucks, and they'd send you a cassette and some Xerox sheets. And a lot of what you will hear is nonsense, is not true, is made up. It's just a sales pitch. So when people give financial advice or tell you about a system that works, you have to check it out yourself. Don't believe anything you say. I only know a few of the people in the audience here. You know, for all you know, everything you hear in the next 50 minutes is made up. This is one of my favorite. This is a lady named Wendy Kirkland. I got this ad earlier in the year. Doubled your money in 2 days or less 41 times. Well, is that possible? No, it's not really possible. You see up at the top, 2 raised to the 41st power is a very large number. If you made a $100 investment, you'd have a couple quadrillion dollars following her system. Nonetheless, I sent my $49 in because it came with a money back guarantee. What I got was a fairly accurate summary of some technical indicators, but certainly nothing that was going to teach me how to double my money.
There's only one book I know that will do that, and that's the United States government. They print more money.
That's true. That is true. This is how I look at the market. And there are actually some important points in this, and mainly that you keep score with money. It doesn't matter how many degrees someone has or what titles they have. You can look at the results they've obtained. I've seen we've run out of seats. I'm sorry. There's a nice there's a seat here. There's a nice comfy bed in the corner, which I would actually prefer to be in. I got started in the area of neural networks some years ago. I was doing graduate work at the National Institutes of Health. I was studying positron emission tomography, which is a kind of functional imaging that shows you how much, in this particular case, how much glucose is being used by various areas of the brain. And one of the tests that had been done manually was to identify various regions in the brain. I read about neural networks. This was back when there was really no commercial software. You would read an algorithm, code something up in C, and I was there for 3 years. I presented a conference towards the end where I presented my work. I had put a lot of work into this, and towards the end, I wanted to show that neural networks were more of a more general tool, didn't just apply here. And I showed a very small, crude system to predict S&P 500 prices 10 days hence. And my talk finished, and then the chairman of my department said, "Don, that was very interesting." He said, "Could you go back to that slide about the S&P 500? And all of the questions were about that. Nobody asked a single question about the past 3 years of my work. So I decided, okay, maybe this is something to look into.
That was 1985.
1985, yes. Yeah. Yeah, I'm old. This is a summary of what I hope to prove to you, to convince you of in this talk. One, that stocks are the place to be. Two, you can time the market. A lot of people say, oh, you can't time the market. And I will show you convincingly, I hope, that that's nonsense. Three, that technical analysis is a good way to go about timing the market. And four, that neural networks and genetic algorithms, the topic of this talk, can make a good system a little bit better. They're not a panacea for anything, but they can help. This is a fantastic graph. It's from a book called Stocks for the Long Term by Jeremy Siegel, who's a tenured professor at Penn, a very smart man. And you can see that stocks vastly outperform other asset classes. In fact, the dollar has lost 95% of its value in this time period, and stocks have increased dramatically in value. Now, there's one asset class that's missing from this graph. Yes, you got it.
This is explain what real return is real quick.
Oh, sorry.
Could you explain what real return is?
Real return is inflation adjusted. Thank you. I just caught the very end of your talk, but I take it you're a financial person. Okay. Real estate, and this is the house I grew up in Springfield, New Jersey. My father bought this with his GI benefits in the early 1950s for something like $10,000. It's now listed at $660,000. It is exactly the same house. I mean, nothing's been added onto it. I think there's a new refrigerator in the kitchen, but that's about it. But
Refrigerator.
yeah, but real estate's very different than investing in the stock market. It's a longer term investment. There are significant costs getting in and getting out. For every friend I have that's made money flipping houses in the short term, I have 2 friends that have lost money. So I just wanted to mention it because Professor Siegel didn't. Okay, now I don't have a whole lot to say, so I fill up some of the space with these stupid jokes. On the left, that's the P-48 Thunderbolt. These are World War II fighters. On the right, that's the P-37 Lightning, and below is a very, very scary clown. So you've got Thunderbolt and Lightning, very, very frightening. And if you know Bohemian Rhapsody, you can fill in. All right, anyway, so this is Professor Siegel, and he says, you don't have to be a timer to do well in the market. Well, okay, he's right. If you're 20 years old and you have a good job and you just want to put your money in the market and not look at it until you're 65, you'll probably do all right. If you're my age, buy and hold might not be such a great idea. I can't say that Professor Siegel is wrong here, but I would say you can do much better if you time the market. Here's a couple of buy and hold facts. Over the past 88 years, you would have done pretty well in the Dow, but on 7 occasions, the Dow dropped more than 50%, and the average period to recover was 9 years. If you're in your 60s, 70s, that might not be acceptable. I just heard this a few days ago. I have not verified this fact, but Charles Payne, who's a commentator on one of the financial networks, said that in 2022, equities lost $15 trillion. And I don't know if he was speaking US or worldwide, and that since the turn of the millennium, that was dropped 40% on 3 occasions. This is a sort of complicated graph. This is a friend of mine back in Colorado, Don Rosenthal, who was used to be an economist at State Street Bank, one of those too big to fail banks in Boston. And what this graph means is if you look, if for each year, if you invested $1, what you would have 10 years later. And you can see that in a number of cases, you would be below the median line of your median return would be $2.09. But in many cases, you'd be below that. And in some cases, you would be well below $1. You would have lost money in 10 years. This is another graph just showing the S&P historical composite. And you can see some fairly significant drawdowns, 69%, 81%, 54%. And while the market did recover, it took a while, and you've lost all that time that your money doesn't have to grow.
Could you explain what the difference between the S&P is and something else? So, for example, another stock.
Yeah, the S&P is a cap weighted index of the 500 largest companies in the U.S. It does not exactly parallel, say, the NASDAQ 100 or the Dow, but it's a good measure of the broad market. Not the best, but anyway, I would say buy and hold is a recipe for disaster for many people. This was an article in Bloomberg Business Week, and that's Bogle down in the corner, who's the Vanguard guy, who is a big advocate of buy and hold. And the article, if you read the article, I realize you can't see the text, but they make an argument that you can't beat the market, you can't time the market, is what they're saying. But why listen to the experts? This was at one hospital where I worked. They had some computer consultants come in and paid them a lot of money to say how to be more efficient. And if you can see here, what they said was that, oh, if every workstation had 2 monitors, you'd be more efficient. And what you can see here is that that's actually a monitor. It's not a corkboard. And the ladies in my lab put the second monitor to good use. Even these guys, who I think won like a Nobel Prize in economics some years back, they came up with this concept called the efficient market hypothesis, or something like that. And it basically said that the market is efficient. At any moment, the market accurately reflects the value of the underlying stocks. And therefore, the next movement of the market is random. It's either up or down, but you can't predict it. And okay, that's nonsense. As the past week has demonstrated, for example, the market is not efficient. And they came up with this line, which just kind of blew my mind. The premier anomaly is momentum, because there is momentum in the market. And they realized this, but it didn't fit their theory, so they just called it an anomaly. I guess if you're a flat earther, gravity must seem like an anomaly to you. And Don and I have a high school classmate who is a flat earther. I'll tell you who he is later. He posts on Facebook all the time. He also believes virtually every conspiracy theory out there. This is a great quote from the genius Einstein. If you say the market is efficient, you can't predict the market, and I can show you an example where you can, well, then they're wrong, according to Einstein. All right, here's a couple examples. This was the very first book I bought about the stock market logic, and they talked about the 4% swing system. It's a very simple system. From any starting point, if the market goes up 4%, you buy. If the market goes down 4%, you sell. That's it. And you can see that there are some circumstances in which this would not work very well. If the market went up 4%, down 4%, up 4%, down 4%, you'd lose your money 4% at a time. But that's not what the market does. The markets have momentum. They go up, they go down. And here, down in the right corner, are the result. Now, this system was described in the 70s, or it expounded upon in this book in the 1970s. So it's been out there for a while. And for every decade since, it has beat the market. Now, I want to stress, this is simply an example to show you that the market can be beat. I gave this talk some years back. And apparently that's all the guy heard in the audience. He came up to me the next year and he said, "It's a great system. Look, I've made money." You know, this is what he was following. I wouldn't recommend following this system. It only works in certain kinds of markets, but it does beat the market. You can see by 1.9%, by 2.9%. You say, so what? You know, you're doing 1% better than I am. These numbers matter over time because of something called compound interest, which incidentally Einstein said was one of the greatest phenomenon on Earth. And that over the long term, if you have, say, a 40-year investing window, you know, you start with 20 to 60, a few percent difference in return are going to make a huge difference in where you come out. So that's one system that beats the market. There's a guy out there named Art Collins. He has a very rough voice. He's very plain spoken. He's a market technician, and he publishes many systems. And then he went back in he's done this in several books, but he went back in 2021. He looked at systems he had published 10 years ago, and he looked how they had done in the subsequent 10 years. And they had done well. Now, it's possible he may only select the systems that did well. There could be some selection bias in there. But this is about as simple a system as you can get. If you're day trading, you watch the market for the first 5 minutes. The market is the first bar, first 5-minute bar is up. You go long, you close at the end of the day. Same way if the first bar is down, you go short. And his system did pretty well. Now, he uses an unusual metric called return on account, where he takes the maximum profit divided by the maximum, the profit divided by the maximum drawdown. And this system has done well. And he has a whole book full of these systems that beat the market. These are inexpensive books available on Amazon, by the way. Our youngest guest ever. This is a system of my development. There's a soft bed in the corner here.
For me.
Well, I'd like to be there, but
Young man,
so this is a system I showed at one of these talks almost 20 years ago. System's called Delta. It's my website is nquant.com. These are some of the returns from this system over the past, I guess, 17 years. This is a subscription system, or available by subscription, but this system has beaten the market quite reliably. Whatever you do in the market, you've got to have a plan, and this is one of my favorite Dilbert cartoons. Better than average, according to you. I think that's a great line. So anyway, there's an infinite number of ways to analyze the market, but they fall into, or many of them fall into, two basic categories: fundamental and technical. And I'm not here to talk about fundamental analysis, except to say that's looking at the fundamentals of a company. What do they make? What market are they in? What are their earnings? Things of that sort. This is the kind of work that Peter Lynch or Warren Buffett excel at. These are two exceptional stock pickers. I don't think I can do as well as them. I mean, they have an entire team of experts. I mean, to say you're analyzing an oil company, you have to know economics, finance, energy, oil, and then the specifics of what that particular oil. You have to know so much information. No one person can possibly know that. On the other hand, technical analysis is mathematics based. You have the same information that some guy at BlackRock does, or whatever. It's a much more level playing field. This is a jab at fundamental analysis. If you listen to any of the financial news networks, they always say something like this. The market shrugged off, if the market is up that day, the market shrugged off news from the Fed today. And if the market goes down, the market reacted negatively to news from the Fed. It's always, it's easy to comment on what's happened, but it's much more difficult to predict. This is, if you're going to do any kind of market analysis, I would recommend this book. It's out of print, but it's available on Amazon. Do-It-Yourself Portfolio Management by Lyle Wilkinson. Great, great book. It's 20 or 25 years old. The markets are not random, and I think this is a brilliant statement because they're based on human behavior, and human behavior, especially mass behavior, as we've seen with the SVB incident, is not random. It's not. This is a great sign. This is at the north gate of the Air Force Academy in Colorado Springs, where my daughter attended. And this sign makes absolutely no sense if you're at the gate. Oh, you can't come in, you're a commercial truck. Oh, but I have a bomb. Oh, okay, come right in. No, in reality, it makes perfect sense in the military mind because the explosive inspection station is right inside the north gate. And you will be escorted by serious-looking people with automatic weapons as you go there. But anyway, every time I saw this sign, I laugh. Technical analysis can be divided into two large categories, and many, many others, but there's chart reading and algorithmic or mechanical trading. Charts confuse me. In this chart, all of the straight lines are drawn by a person. Somewhat, there's a lot of discretion in how you draw lines. To me, it's just too much information. I can't absorb it all. I'm simple. I want a yes or no answer to things. How are we doing it? All right. So the joke is, a horse walks into a bar and says, "I'd like a drink." The bartender says, "You've been in here an awful lot. Do you think you're an alcoholic?" And the horse says, "I don't think I am." And he disappears. And I could have started off by mentioning the philosopher who said, "I think, therefore I am," but that would have been putting Descartes before the horse. Thank you. Some characteristics of algorithmic trading. It's non-discretionary. You're not sitting there going, "Oh, what do I think the market's going to do?" You have an answer determined by math. It's based on indicators, a little bit more about those coming up. It has rules. The systems can be optimized, and most importantly, if you're a scientist and you're familiar with the scientific method, it can be tested by the same tenets that are used or that should be used to test scientific theories. I will have to complain that NIH and CDC during the pandemic did not follow the scientific method, but that's a topic for another talk. We're not talking about the Babbage differential engine here, a beautifully designed mechanical computer that can perform 2 instructions per second. Indicators are essential in technical analysis, and they are generally functions. There's really only 2 independent variables. There's a few others, but price and volume are the main 2 independent variables. Things like option volume might be considered another. Oh yeah, there's my dig at what our government said during the pandemic. So let's look at a system, and we're going to use just 3 technical indicators here: simple moving average, exponential moving average, and RSI. And now I'm going to tell you what each of them is. Simple moving average is simply the average for a given number of periods of the past n values. So if it's a 5-day moving average, then it's the closed today, 1 day ago, 2 days ago, 3 days ago, and 4 days ago. And it's called a moving average because each day you recalculate it. A general principle in technical analysis is that if the price is above the moving average, because the moving average is basically a low pass filter, it's filtering out the high noise. If the price, and it's going to lag the price, if the price is going up, the moving average is going to go up, but more slowly. So if the price is above the moving average, that's generally indicative that prices are increasing. And if a shorter period moving average is greater than a longer period, that also indicates an uptrend. Now this graph shows us an exponential moving average. The problem with moving averages is that they equally weight all of the past periods. So if you have one day you have a 20% decline in the market, and then you're moving the moving average, that at some period that decline is going to drop off and the moving average is going to move abruptly. Exponential moving averages give more weight to the more recent prices. And here's a general formula. But all we can say is that exponential moving averages track a little better. Here, the blue line is an exponential moving average. You can say it lags the price, but not as much as the red line, which is a simple moving average. There's another indicator called the relative strength indicator or index. I think it's index actually. And this is an oscillator. I'll show you a graph in a second. If you look up, anywhere, go on the internet, look at an Investopedia or something like that, they'll give you this top formula on the top, which I think is just terrible. You look at that, you go, what does that mean? I can't wrap my mind around it. You do a little bit of algebraic simplification like they taught us in 9th grade, and you end up with this bottom, which is much better. And it's simply the sum of the up movements. If I think we have a seat right over here, my friend.
Yeah, that's okay.
Okay. It's the sum of the up movements divided by the sum of the up movements and the sum of the down movements. So basically, you can see if the market closes up each day, then say CU is 1 and CD is 0, that's going to be 1. If the market's closing down each day, it's going to be 0. And you get an oscillator. On the bottom, we see the RSI. And you can see as the market's moving up, so is the RSI. And as the market's moving down, so is RSI. Now, people use this by itself in a lot of different ways. They'll say, oh, if the RSI is peaking, say above 80, that means the market is getting toppy and might be due for a downturn. But that doesn't always work. Markets can remain overbought or oversold for long periods of time. But that's another indicator. Now, if you weren't using neural nets and genetic algorithms, and I'll explain what they are briefly in just a few minutes, you might put a system together like this. You might say, well, if the close is above the 50-day simple moving average, and the 50-day moving average is above the 200-day moving average, and the close is above the exponential moving average, and the RSI is below 20, then I might go long. I've seen systems that look like that. Oh yeah, people are always encouraging. We drink a lot of coffee in our household. It's, oh, you should drink tea. You should drink green tea. You should drink black tea. Whatever. So one technique is called genetic algorithms, and these are based on what happens in evolution, if you believe in that. And that is, we assign each rule and each parameter of the rule. A parameter would be like the 50 and a 50-day moving average. We assign that and we call it a gene. And then we recombine these genes in methods similar to what happens in evolution. A gene can just be copied, it can cross over, a gene can become extinct. On the right-hand side, we see like a second generation crossover, like what you might get from your grandparents, say. And what's the advantage of this? Well, oh yeah, I think this is XKCD. I think these cartoons are great. So this is showing a genetic algorithm in action. And on the left side, each blue bar is a possible combination of genes. And what we're trying to do is get to the most optimal solution, which is the bottom of this three-dimensional grid. And then we see later on, some of the genes have died off, and the red line is indicating the best possible solution. If you've ever taken a computer science course, you might have been confronted with the N-Kings problem. This is how do you place like 8 queen problem, sorry. How do you place 8 queens on a chessboard so that no queen is attacking each other? And typically, a crude way to solve this is you have, for I equals 1 to 8, for j equals 1 to 8, for k equals 1 to 8, you have 8 nested loops. And you run through, and then for each possible location of the queens on the board, you test is any queen attacking each other. And on average, that's going to take you half of 8 to the 8th. Anyway, if you do it with a genetic algorithm, you can typically do it in about 1/100th of the number of steps. Hey, Joe, how are you? All right, quick run through of genetic algorithms. Now we'll talk about neural networks. Neural networks try to simulate how the brain works. The human brain has something like 100 billion neurons, and each of those neurons can make up to 10,000 connections or synapses with other neurons. Now, things in neurophysiology, things happen in millisecond times, not the nanosecond times that they happen in computers. But since there's so many neurons working on a problem, they're able to do amazingly complex things in amazingly short periods of time. The retina, for example, may have up to 10 million neurons just within the back of the eye, and the retina itself and its 2 additional layers are able to do things like sense motion, detect edges, things of that sort. I mean, it's the idea is that by combining a number of very simple neuronal structures into a network, you can accomplish complex tasks. Here's some simple schematics. The networks that I'll use in this example have 3 layers: the input layer, and the inputs might be things like simple moving average, simple moving average of another period, exponential moving average, and then a hidden layer, which we don't see, and then the output layer. On the right is a more complex neural network that might be used in something like artificial vision or something of that sort, deep convolution networks. The feed-forward backpropagation network is a network that's been described for a long time. Has basically we start off with the knowledge of the network is all contained in the weights between the various neurons. We start off with those weights set randomly. We show it some inputs. We say, oh no, that's not the right output. And then the error is propagated backward through the network, and the weights are adjusted slightly, and we run it again. And we continue to run it until we achieve acceptable error. The problem with neural networks is that it's very difficult to say what's going on inside of them. They're very complicated. And even with a simple network with just 20 or 30 neurons and all the associated weights, it's very difficult to know what's going on inside them. This, incidentally, is not an American city. So how do we use them together, neural networks and genetic algorithms? We do an iterative process. See, because if I present you with this system that we're looking at, the first question is, what are the best parameters? I mean, I may start off with 50-day and 200-day moving averages, but are those really the best? And then the second question is, how do I combine them? I mean, most simple systems just say, add them up. If you get 1 point for each, if it's a 3 or greater, go long. But maybe it's not. Maybe the ideal combination is not a linear combination. Maybe it's a fairly complex, higher order combination. Neural networks got a really bad reputation when they were first introduced in the financial world because people did not understand the fact that you can over-optimize a neural network. And when you do that, the beauty of a neural network is that it can generalize. But if you over-optimize it, it just learns the specific data that you're showing it. And that was not understood at first. I used to show a slide in these talks where I took interstation white noise and optimized using that as an indicator. And it was perfectly happy to learn what's called the in-sample data. But as soon as you showed it data it hadn't seen, it completely fell apart. We don't want some system that is so jury-rigged that it falls apart very easily. Like, what is that, a European socket? Yeah. We don't want that. So we have to be a little more, I mean, if I come up with a system and I say, if the sun is shining, go long, and that's it, I can test it. I can take the next 100 days, the sun is shining, I go long, the sun is not, I go short. Wouldn't work in Colorado, by the way. We have a lot of sunshine. In fact, there's a poster in the airport that says Colorado gets 300 days of sunshine a year and spends 365 days a year telling other people about it. This is called walk-forward testing, and it's sort of clever. And this actually simulates what would happen in real life. Now, I would train the network on some data that I knew the answer to. That's the first blue bar at the top. And then I would take a next period that it hadn't seen the data on, and I'd say, hey, can you predict what's going to happen in this data you haven't seen before? And if the answer was, yes, I can, well, then I'd take all that data now and train the second time, the second blue bar, and then I would show it some more data it hadn't seen. And I'd walk forward through the data. And if it did pretty well in each of these iterations, and this is what would happen in real life, because you would start out, you would train a system, and then you would test it on some data it hadn't seen, and then you would retrain the system using all the data you had, and then test it on the next week's data that you hadn't seen. And if you add up all the green bars down at the bottom, that's the sum of your out of sample data. And if it's doing okay in the out of sample data, you can be somewhat confident that you have a system that's going to continue to do well. I'm not going to speak about Monte Carlo testing because I didn't have the time to do that work in this system. But Monte Carlo testing is another step forward in where see, the problem with financial data is you have a limited amount of it. Even if you have 20 years of data, 250 trading days in a year, that's all you have. You have 5,000 data points. With Monte Carlo testing, we make up artificial series. We take over a period of time, we take the prices and jumble them, or we take the percent change in the prices and we jumble those, and we end up with data series that look like the original data but are artificial. And then there's no limit to the number of things you can do there. Now, say for example, I mean, a good example of this is, say you wanted a system on how to play blackjack, not card counting, because you don't want to get beat up in the casino, but just what's the best bet given each possible combination of what the dealer's showing and what you have. And say you wanted to do, a lot of casinos use 6 decks now. So that would be 52 times 6 factorial is the possible number of hands that could be in the dealer's shoe. Well, there's no way you could reasonably test everyone. I have no idea what that number is, but it's a very large number. There's no way you could test every possible combination. But what you could do is you could take, say, 1,000 or 5,000 or 10,000 random hands and test. And statistically, you can show the larger your number gets, the smaller your error is going to become in devising your system. That would be another situation where you would try that. So this is our system. We're actually nearing the end of our talk, and you can see the blue arrows. So we've trained this system. We've done walk forward testing, and now these are the results. The long trades are the blue up arrows, and the short trades are the red down arrows. And you can see some of the trades did pretty well. if you look at, yeah, well, I don't have a pointer. The November, the up bar, and then there's a long uptrend. And it's mostly long during that period. There are some short trades, but mostly long. And then there's some trades that it didn't do so well in. There's a trade in the, what's it? A short trade about 3/4 of the way across the graph. That doesn't show up. Where the market's still going up. So it's not perfect, but how did it do? So here's some of our results. First of all, we take the system I showed a little earlier, where we have no neural networks or artificial or genetic algorithms involved, just the initial rules I showed. And the system, this is with a 2-year training period and 6-month out of sample testing. Did 10.6% annually with a 21% drawdown. A drawdown is the other major criterion evaluating a system. It's the biggest negative excursion. If you look at your account each day, the biggest negative change you would see. And in general, we want higher return and lower drawdown. The more conservative you are, the less drawdown you're willing to accept in return for a higher return. And then we can see as we add in, if we use just a neural network, in other words, we take the initial parameters that we had, 50 and 200 day for the moving averages, 15 for the exponential moving average, et cetera. We don't do any optimization of the parameters, and we use all the rules. The system does a little bit better. If we use them together in an iterative fashion, the system does even better. The drawdown is less. That's with 1 out of sample testing. If we do 10 walk forwards, remember a walk forward is a more rigorous way to test a system, the return goes down slightly, as it might. And then during that period, if we did nothing, just bought the stock and held onto it, this was a period of during last year, 6-month period where it would have declined 12.4%. So using a system, using a technical system does better. Using it with an artificial neural network does a little better. Using it with an artificial neural network and a genetic algorithm, it does even better. And
The training means doing some manipulation? What is that training?
I'm sorry?
You said train, you have to train the model, right?
Training. Yeah, 18-month training period, 6-month testing period.
The drawdown is 38% last year, which is this like index or this is one slide?
Yeah, I'm not sure what period.
QQQ spot.
Sorry, yeah, oh yeah.
It didn't go down 38%.
That could be an error.
Saying you don't use
Buy and hold the last year didn't go down 38.
Yeah, that's a good point. That could be an error.
No, it didn't.
Maybe it's for a different time period.
Yeah, no, it could just be.
That's a peak hold drawdown.
I was
Over
thinking,
buy and hold. That's, you don't do anything, just watch the market. But it's sitting there. It's not using any algorithm. It's not doing anything.
Yeah,
You're quoting 38%.
last year, I was happy.
Okay. Last year I lost a lot using buy.
For Q2 and
I also use his technique and I can test it with those numbers.
which instrument?
QQQ and
We
spot.
do QQ and spot. They're QQQ, they're index.
Okay, that could simply be a mistake. Important point that I've demonstrated in previous talks and won't go into in detail here is that price action is similar across different instruments and time frames. Meaning, if I show you a daily chart and a 5-minute chart, and I don't label the axes, I don't think you could tell which is which. And if you're going to trade technically, you'll generally do better trading shorter time periods because there's more excursion. The maximum possible profit is higher the shorter the interval is. And in previous lectures, I've shown, for example, the same system traded on daily bars and 10-minute bars. 10-minute bars do better. So getting towards the end, what should we trade? We're trading stocks and stock derivatives, options. I'm an option trader as well. Futures, particularly if you're trading indices, futures have a really big advantage in that for some reason, capital gains in futures are treated as 60% long-term, 40% short-term. I have no idea why, except that futures traders probably contributed to somebody's campaign fund, but there's some definite advantages to trading futures. Also, the margin requirement is quite a bit less. So here's what you shouldn't trade. Well, there's lots of things you shouldn't trade, but to my mind, ESG funds, and ESG stands for something like environmental, societal, and governance. Social and governance. Okay, they're woke funds. And yeah, here's why.
Who makes the decision? Corporation.
Absolutely.
Entire countries have gone out of
The last time I looked, the S&P 500, the S&P ESG index included ExxonMobil and excluded Tesla. Now, how is that possible? Come on. I mean, what?
Greenwashing from like BlackRock and some of the other ones, they will make a green fund. But if you're not actually looking what's in the fund, it will include things like oil companies, which are traditionally not in favor of climate change, shall we say, and they are labeled green because there is no actual definition for what makes an ESG.
That is very well said, my friend.
It's probably not all company are big. Some other company, for example, General Dynamics.
And that would all be okay with me if they did well, but they don't. There's the top line, the ironically green line is the Dow, and the ones below it are all ESG funds, which have significantly underperformed the Dow. And if you look at a lot of ESG funds, you will find, since a lot of them are cap weighted, and they've all got Apple, Google, they have the top tech stocks in them because they all say the right things. It doesn't matter that your iPhone might be made by, child slave labor over in, somewhere in China. They say the right things, so they're ESG funds. The bottom line is that the ESG funds look an awful lot like the S&P 500 because they're all cap weighted, and just the small modifications they seem to make really contribute to underperformance. So anyway, that's one thing I would advise not investing in.
You're doing good. It should be more tolerable for lower returns, but I do not think there's.
But the question is, are you even doing good? If they include Exxon and exclude Tesla, the reason for excluding Tesla is, the real reason probably is that Elon Musk is a loose cannon and doesn't always say the proper things. They'll say things. Yeah.
So Tesla is at least 50% owned by this.
Oh.
This guy, I don't know who Elon Musk is. Doesn't talks a very free, free exchange of information, but that his money, his company is owned by basically a company.
Ah,
Yeah,
wow.
it came from Marx. But by the way, I just checked last year, the drawdown is about the 30, 31, 30%. I don't know, you may have done
Are you?
and also, I don't think there's a lot of slave labor, like child slave labor in China is the GDP is pretty high. Relative.
Yeah.
I don't agree with that.
Okay. I was just
Yeah,
speaking off the cuff about Apple.
That's a conversation.
So this is what not to buy. What do we buy?
What?
This is what not to buy.
Oh, anything else? I've spent a lot of
That's you.
time just investing in the S&P 500, SPY, and SPY futures. You can open a futures account at almost any brokerage. For some reason, they like to treat it a little bit differently. Margin requirements are less, I think, and with most brokers, but it's not difficult to trade futures, and it has.
lose a lot of money.
Well, if you don't leverage yourself, it has exactly the same risk as buying, like SPY. If you go highly leveraged, you can absolutely lose a lot of money. But I don't trade highly leveraged, and I don't recommend it.
So you set your budgets,
Mhm.
what I and what is expected.
Okay. So we're almost at the end here. I would point out the website nclock.com has some previous papers when we used to submit papers for TCF talks. We don't do that anymore. And it does allow you to subscribe to these signals that I showed the results of a little bit earlier. That's about it. Fat lady has sung.
Quick question.
Yes.
With this system, what are your thoughts about using it in regards to the before and after hours trading?
Well, the Delta system specifically is just for trading during the day session. There's no reason that you can't use systems like this for trading after hours, but I haven't done that extensively. But
I'd like to add, Don has been coming here for many years. And I'm a personal friend of Don, and I actually subscribed to this system. And there were recent years, not last year, the year before that, I was making over 40%. And I'm not a shill for him. He's not paying me anything.
Oh.
Give him some bonus.
I mean, right now you get a CD, the best CD I was able to buy is 4.5%. That's it. That's this does much better, at least twice.
Highest one to 522 right now.
So I'll put in a little plug here if you're interested in helping the Ukrainians out. This is one organization that I've vetted, I think is a reliable organization. And that's the end. I'll be happy to take any questions.
Yes, Richard.